With his own private company, Buffett Partnership Limited, he generated the biggest returns in his career's early years. The business existed from 1957 to 1969, and during that period, the renowned investor used his stock market assets to achieve an astounding average return of 29.5% each year. However, because he employs a relatively straightforward method known as value investing, very much anyone with a working grasp of finance could do the same. "You don't need to be a rocket scientist," he once said. The person with a 160 IQ does not necessarily triumph over the person with a 130 IQ in the game of investing. Reasonability is crucial. You must have a strong personality. Here are 7 rules by Warren Buffett to achieve 30% revenue per year. Before starting, don't forget to like and subscribe our channel for more future updates. So let's start. Number 1. Buy business success, not stock gains. Benjamin Graham, a well-known investor, was the one who initially developed this principle. Warren Buffett wasn't even the one who proposed it. Buffett was instructed by the author of the widely read book, The Intelligent Investor, that owning a stock is the same as owning a business, and that the performance of the stock will only follow the performance of the firm. When making investments, you should keep this in mind and focus on the companies that are going to dominate them. Market in the future rather than the companies that are doing well right now. You ought to focus on companies that have large profit margins, those that have a significant advantage over their competitors, and those that are favored by customers because, if the company is successful, so will your investment. Number 2. Most news is not actual news. Buffett is of the opinion that the majority of the news we receive about investing is actually not relevant when purchasing a financial instrument. This is arguably his opinion that is least popular with other people. In this day and age of the internet, everyone from finance programs to newspapers to YouTubers all have a vested interest in having you listen to what they have to say. Even when they don't use clickbait, they still try to generate as much excitement and anxiety as they can in order to get you to click and watch their videos. But if you want to invest for the long term, you only need to focus on a small portion of those factors. Owners of stocks far too often let the arbitrary and irrational behavior of their fellow owners compel them to behave irrationally as well. This is a common problem in the stock market. Some investors believe it is vital to listen to pundits since there is so much conversation about the markets, the economy, interest rates, and other topics. Even worse, these investors may consider acting upon the views of the pundits. Number 3. Not everyone is trustworthy. What I just mentioned doesn't mean that you shouldn't pay any attention to what other people have to say. Even Warren Buffett has had more than one mentor throughout the course of his career. First, it was Benjamin Graham, and then it was Charlie Munger. And now, us regular investors are able to utilize the internet to track the precise actions of many of the world's most successful investors, including Buffett himself, in real time. However, trust is the most important thing to consider in this situation. Should you believe a random YouTuber who only wants you to click on his affiliate link? Probably not. You should only pay attention to the advice of those you already know and respect. Your requirements should take precedence over the expectations of others when it comes to selecting an appropriate investment. Number 4. Plan on holding forever. Compound interest is quite potent, as you have surely already heard. Reinvesting your earnings from dividends and capital gains enables you to increase your wealth. However, if you continue to purchase and sell equities, you're likely not allowing compound interest to work its magic and losing out on a lot of long-term returns. Due to this, timing the markets rather than timing them is crucial. Because of this, you should be ready to hang on to that stock forever. If you perform your due diligence before buying, there is usually never a good time to sell. Number 5. Know intrinsic value. And this is what Buffett meant by performing your job right. When it comes to investing, all the other rules are essentially useless if you don't abide by this specific one. No matter how excellent the firm or its managers are, you must realize that they cannot be bought for an unlimited amount. You must keep the price below what they are truly worth. Nobody questions the excellence of a Ferrari, but that's not what you're questioning when you consider purchasing one. Whether it is worth the $250,000 price tag is up to you to determine. Stocks may be considered to be exactly the same, which is why Buffett himself states, "No business, no matter how great, is worth an infinite cost. Value is what you get, price is what you pay." And you must first understand how to compute intrinsic value in order to determine the value of each investment. Number 6. Understand what you're buying. The company you are buying should be known to you. This is really basic but also very straightforward. The fact that the companies Buffett invests in are genuinely quite simple is perhaps one of the only patterns in his portfolio. Soft drinks are sold by Coca-Cola, iPhones and iPads are sold by Apple, Southwest is an airline, and Furniture Mart also seems to be very self-explanatory. Risk only results from a lack of knowledge. If you have a passion for vehicles, you should research Ford or Tesla stock. If you are interested in e-commerce, research Amazon. If you are interested in social media, research Facebook. But only purchase those you truly comprehend. Asking yourself, would I be able to explain to a 5-year-old how this company earns money? Is an easy method to test this. Number 7. Be fearful when others are greedy. If you had started investing in January, it would have been beneficial to be aware of this guideline because it is helpful when bull markets last a very long time. Everyone becomes avaricious when the market keeps rising in stocks like Apple, whose value doubled in 24 months. People often become overconfident in their ability to invest during these times and pour even more money into the market, making it more and more difficult to find a decent deal. You need to be extra cautious in these situations, which is exactly what Buffett did last year by amassing $128 billion in cash, almost half the value of his entire portfolio. But if there's one thing we can count on, it's that when stock market panic starts to spread, he'll be buying up plenty of discounted stocks. What do you think of our video? Which rule do you like most? Let us know in the comment section below. Don't forget to like and subscribe our channel for more future updates. Thanks for watching.